Bismillahirrahmanirrahim. Assalamu alaikum. This is Junaid Khalid, and today in this video we are going to discuss the situation or the scenario of a multiple subsidiary. Although this is not yet examinable in the financial reporting paper, but that is the part of your curriculum and a very minor part and a very small part. So let's have a basic question of that multiple subsidiary question. In that scenario, we are going to discuss that if the parent has multiple subsidiaries, means if the parent company has invested in two companies and all of those two companies are the subsidiary companies, it means parent company has acquired more than 50% ordinary shares of two companies. It means the parent will have two subsidiaries. Now, how the consolidated accounts, how the financial statement will be consolidated, in this video lecture we are going to study. First thing is, you need to keep in your mind, if the parent company has multiple subsidiaries, in that scenario, in that case, no major changes will arise. We will apply all those aspects of the consolidation which we have applied in a single subsidiary case. So let's discuss the question and let's read out the question, what's going on, and we'll consolidate the P&L of a parent and a multiple subsidiaries. So question is, Naya company bought 75% of the Media company on 1st of July 2008. Let's recall, let's see that what is the date of reporting. The date of reporting is 31st of December 2008, and Naya, that is parent company, acquired Media company on 1st of July. It means there is a mid-year acquisition. So we need to keep in mind it's a mid-year acquisition, and held 80% lien for many years. It means whenever we see a question in which the financial statements of three companies are given, normally a candidate or a student sees that or observes that one company is the parent company, other one is the subsidiary, and the third one is the associate company. But in that situation, if we just look at the holding of a Naya company in that is the Media company and the lien company, in both the situation the acquisition is more than 50%. It means there is no associate company. Both of these companies are subsidiary companies. Now the P&L of point to be remembered, that Naya company, that is the parent company, acquired Media company on 1st of July, that is the mid-year acquisition, and Naya company acquired lien company for several years or many years ago. It means it's not a mid-year acquisition question. P&L of three companies is given in the question. Now there are some other information given in the question. Let's read out all those adjustments. On 1st of July 2008, it means the date at which the lien company was acquired, the date at which the Media company was acquired. On 1st January 2008, an item of the plant in the books of a Media company had a fair value of 20,000 in excess of its carrying amount. That shows the revaluation surplus. At this time, the plant had a remaining life of 5 years and depreciation is charged to cost of sales. Let me recall one thing. Whatever the adjustments or whatever the treatment we performed in a single subsidiary case, the same treatment will be adopted in a multiple subsidiary case. There will be no major changes. But the thing is, you have to be very attentive in that question so that small or the minor errors don't arise. Second adjustment is, during the post-acquisition period, Media company sold goods to Naya company for $10,000. That is the sales by the subsidiary company to parent company, 1/4 of which remain in the inventory Naya company at the year end. It means the parent company has some goods which are unsold at the end of the year. It means if the goods are unsold at the end of the year, the URP, that is provision for URP, unrealized profit, would arise. Media company earns a margin of 40% on its sales. Good, okay. Third one is the goodwill on the acquisition of lien company. It means when the lien company was acquired, which had been measured using the fair value method, is to be impaired by $1,000 at the year end. It means there is an impairment loss, and the goodwill of a lien company is impaired, not the Media company. Impairment loss of $1,000. Impairment losses should be charged to operating expenses. Good. Fourth one is the on 1st October 2001, 1st of October 2008, lien company paid a dividend of $5,000. Always remember, if a subsidiary is paying a dividend, that dividend, 100% dividend, does not belong to the parent company. Definitely lien paid a dividend of $5,000. It means the acquisition on the lien company is 80%. Yes, 80%. which means the 80% of that dividend will be received by the parent company. And Mira company paid a dividend of 4,000. It means the 75% of 4,000 of the dividend will be received by the parent company, and we all know that it's an intra transactions, and while consolidating the P&L, we are going to eliminate that dividend income from the consolidated profit and loss account. Let's fulfill the requirement. Requirement is to prepare the consolidated profit and loss account for the year ended 31st December 2008. Now, what will be the procedure? What will be the procedure for consolidation? Naya Group financial statements. We are going to prepare the consolidated statement of profit and loss, CSPL, consolidated profit and loss. Let's list down all the line items of the P&L, that is revenues, cost of sales, and then we will be incorporating all those revenues and expenses and the values. The resultant will be known as what? Gross profit. And after that, we are going to deduct the operating expenses. Okay, and then the resultant will be known as what? Profit from operations. Okay, and then we're going to include the investment income. Afterwards, the resultant will be known as what? PBT, that is profit before tax. And then we are going to deduct the tax expense. And after that, the resultant will be known as what? Profit after tax. Okay, let's start with the P&L. Okay, revenues. First of all, let's take out the revenues. One thing which I normally do at the start of the question, that whatever the adjustments we have seen over here, whatever the adjustment we have read it out, let's make some entries for this one, so that it would be easy for us to incorporate all those adjustments. First thing is, there is an adjustment of fair value, and fair value adjustment, I would definitely recall many of the areas of the consolidation in this video, so that you just have a quick recap or the reminder or the recall, or you just flash back each and everything of the consolidation side. Fair value adjustment, that is the revaluation surplus. Basically, the major adjustment of this, the major treatment of this adjustment normally would arise on the balance sheet side. What we did in past when we were practicing the balance sheet, we debited the property, plant and equipment, and we recorded the revaluation surplus, that is the net assets at the date of acquisition. So first adjustment was done in the balance sheet, that is we increased the value of assets, and we increased the net assets at the date of acquisition of a subsidiary company. Second thing is, if the subsidiary has not yet recognized that revaluation surplus, definitely the subsidiary would have not recognized the depreciation, of that revalued amount or the revaluation surplus. So what we need to do, we need to record that depreciation. We recorded that depreciation in the balance sheet, but that was recorded in an accumulated way, that is, if the date of acquisition and the date of reporting, for instance, it's a duration of 3 years, so we recorded that depreciation adjustment for 3 years in the net assets working. But for consolidation P&L, consolidated P&L, we normally account for the depreciation for the current year. But now here, Mira company was acquired in the mid of the year, so you need to concentrate. Okay, Mira company was acquired in the mid of the year, so it means the depreciation would also be prorated on the post acquisition months. Okay, so it means that adjustment of depreciation is required. Revaluation surplus adjustment is not required in P&L, although it is required in the balance sheet. Okay, now let's calculate the depreciation. Working one, we are going to calculate the fair value depreciation. Fair value depreciation. Okay, now the value of asset or the revaluation surplus amount was 20,000, and divided by useful life was 5 years, and definitely we are going to calculate the depreciation for 6 months, that is if I would say the acquisition date was on 1st July and reporting date is 31st December, it means 6 months are the post acquisition months. This would arise 2000 and the depreciation will be eliminated, or the depreciation will be recorded in the consolidated P&L. And this depreciation will be charged definitely to the cost of sales. So we are going to add this in the cost of sales. Okay, second adjustment was during the post acquisition period, Mira sold goods working to Mira, that means subsidiary, that is Mira sold goods to a parent company, that is Naya, which is the parent company. Okay, Mira sold some goods to parent company and the sales price is that is selling price is 10,000. Sales is $10,000. Sales is $10,000, and don't forget we need to eliminate that sales and purchases, because that is the intra item, that is the intra transaction. We need to eliminate it. Sales would be 10,000 and definitely purchases of purchases for a parent company would also be 10,000. So 10,000 is the sales and purchase that we need to eliminate. Second thing is, now we are going to calculate the URP, that is unrealized profit, and for that 10,000, that is the sales, and the percentage applied on that is 40% margin. It means 40 divided by 100. That is the total profit. That is total profit. That is not the URP. That is the total profit. And how many goods are unsold? What amount? That is 1/4. 1/4 of the goods are unsold. That is 1/4 divided by 4. It means 1000 is the URP, unrealized profit, and that unrealized profit need to be eliminated. That unrealized profit need to be eliminated from the inventory of a parent company, So we need to remove or eliminate that URP. Okay, the third adjustment is that is the impairment loss. Working 3, although no working is required for the impairment loss, as the amount of impairment loss is already given in the question, but what we need to remember, that impairment loss need to be adjusted, and for that we need to debit the P&L, and definitely the goodwill account will be credited. But right now in P&L we are not discussing the goodwill account, so P&L debit and goodwill credit with the amount of 1000, and this adjustment is required. So I'm just noting down all the adjustments so that I don't forget while preparing the consolidated P&L. Okay, now last one is that is on 1st October, dividend was paid by the Mira Lean company, that is $5,000. Working of dividend paid by Lean company, that is Lean paid the dividend of that is 5,000, but we know that 5,000 is the total dividend paid by the Lean company, and the acquisition in the Lean company is 80%, so it means 80% will be calculated, that is 4,000, and Mira paid a dividend of that is 4,000. It means the 4,000 and the 75% of 4,000, this will make 3,000. It means the total dividend received by the company, parent company, that is Naya company, that is 7,000. Dividend received by a parent company, that is 7,000. So that is what we have worked out, and now it's time to prepare the consolidated P&L. But while preparing the consolidated P&L, please make sure that you prorate the revenues and expenses of Mira company, as Mira company was acquired in mid of the year. Okay, now revenues are, that is 214, that is 2,14,000 is the revenue of a parent company, plus subsidiary company, that is 1,34,000 of a Lean company, and plus in addition to that, that is 1,20,000, but that 1,20,000 will be prorated, so we are just having a bracket open, 1,20,000 and multiply by 6 and divided by 12, bracket close. Are you getting my point? So we have prorated the revenue of subsidiary company, Mira subsidiary company. And now we'll just make the adjustment, whatever the adjustment is required. Try to consolidate the normal financial statement, and then afterwards, once you have a case of multiple subsidiary, try to consolidate the financial statement normal way, and then in the end perform all your adjustments, whatever the adjustments are required. Now the revenues should be eliminated, that one subsidiary sold goods to a parent company, that is 10,000. Revenue of 10,000 will be eliminated. So this is the case. Let's close the bracket, and the answer is 3,98,000 is the group revenues. Okay, now the second line item is, that is cost of sales. The cost of sales of a parent company is 1,30,000. 1,30,000 is the cost of sales, plus 86,000 is the cost of sales of a subsidiary company, plus, and bracket open. Why? Because the cost of sales of a Mira company need to be apportioned. 72,000 multiplied by 6, and that is divided by 12. Bracket close. Okay, now let's recall if there is any adjustment required. Yes, first we need to eliminate the intra purchases, so we deducted that 10,000 from the cost of sales. Second thing is, that is the adjustment of URP. Don't forget the URP, unrealized profit, is 1,000, and we all know that to eliminate the unrealized profit, we need to increase the cost of goods sold, because there is a indirect on the inverse relation between the merchandise ending and cost of sales. That URP will be eliminated from the inventory of a P company, and if you wanted to reduce the inventory of a P company, we need to increase the cost of sales, that is increased by 1,000. Okay, any other adjustment which is required over here? That is the depreciation. Yes, exactly. The depreciation, the fair value depreciation, that is 2,000, which need to be charged to cost of goods sold. It means that will increase the amount of cost of goods sold by 2,000. By 2,000, as there is a fair value depreciation, and in that question examiner specifically identified that there is an adjustment of depreciation required in the cost of sales. Okay, no other adjustment is required. Okay, 2,45,000, that is the cost of goods sold. 3,98,000 is the revenue less cost of goods sold. The gross profit is 1,53,000. Now let's work out on the operating expenses. Operating expense of a parent company is 41,000. 41,000 plus the operating expense of a lean company is 27,000. 27,000 plus the operating expense of a Mira company is 20,000, but we need to apportion it. Although I know that 20,000 is the total operating expenses of Mira company, and 6 months would be the half of it, that is 10,000. But I won't be typing that 10,000. I need to use the formula. I need to show all the calculations to the examiner. So 20,000 multiplied by 6 and divided by 12. So that is the adjustment. That is not the adjustment, but that is the operating expenses of 3 companies we have accounted for. Now let's recall if there is any adjustment required. Yes, the adjustment of impairment loss is required. This will increase the amount of operating expense with the amount of 1,000. Any other adjustment required? No. No other adjustment is required here. So we are going to do total it, and the operating expense is 79,000. So gross profit minus operating expenses, the profit from operation is 74,000. Now the investment income. Investment income of a parent company is 8,000. Investment income of a parent company is 8,000. There is no investment income of a lean company, or neither there is an investment income of a Mira company. So investment income of a parent company is 8,000, but we need to eliminate the intra item, that is the dividend received, that is 7,000. We'll deduct that amount 7,000 from the investment income, and the net resultant would be investment income would be 1,000. So the profit before tax is 74,000 plus, that is, it is investment income. We are going to add it in the profit from operation, that is 75,000 is the profit before tax. Now income tax expense need to be deducted, 12,000 for the parent company, plus 5,000 for the subsidiary lean company, and 6,000 for the another subsidiary, that is Mira, but definitely multiply by 6 and divided by 12. this will result in the 20,000. The income tax is 20,000. So profit after tax is 75,000 minus 20,000, that is 55,000 is the profit after tax. So that was the case. And one more thing which you can do is that if you work out on the right side, on the right panel, what additional thing you can do it, and that would be, I just forgot in that question, but what you can do, that I eliminated that 10,000. I eliminated that 10,000. Okay, what you can do, you can refer the cell, you can refer that cell in which you have worked out, or in which you have the working of that value. You can definitely refer that cell. The advantage of this one is that for instance, you made some error in your calculation, in your working. Once you will rectify that error, once you will rectify that working, automatically your P&L will be updated. So it is recommended if you just refer those cells, that is plus 2,000. That 2,000 was the amount of fair value depreciation. I have calculated the fair value depreciation. So I just click that one. I just refer that cell. For instance, if I took the life incorrect, if I just had the value incorrect value in the calculation or the working, once I will rectify that working, I will update that working, automatically the P&L will also be updated. So it is quite recommended that you just link your cells. Okay, now 1,000, that 1,000 was, I think, the URP. Yes, that was URP. I have calculated that URP. Might be there's a possibility that I might have calculated incorrect URP, and subsequently I just got to know about that that I have calculated incorrect URP, unrealized profit. So I do not need to update my income statement. This will automatically be updated. Okay, this is, and that 10,000 was the intra purchases. That 10,000 was the intra purchases, so I just linked that cell. So this would be a great advantage for you if you have made any error. So hopefully you will not panic in the paper, and definitely the cells will automatically be updated. 1,000, I have adjusted that 1,000 for the impairment loss. So I'm gonna to link that cell with the impairment loss. And any other, yes, investment income, I've already incorporated, or I have already linked the cell in that case. Okay, now that is the profit after tax, but that is not the end. As we all know that the important part is profit attribution. Now profit attributable to. Profit attributable to. Okay, now profit attributable to. Two things, that is number one, the group, and second one is the NCI. It is always feasible to calculate the profit of NCI, that is profit of NCI. Total profit is 55,000. Total profit is 55,000. We need to attribute that total profit in group and in NCI. Now let's calculate the working of NCI, but this time NCI working is going to be I would not say it would be too complicated, but definitely a challenging one. NCI, and we know that right now we don't have only one subsidiary, we have two subsidiaries. And let's calculate the NCI of a subsidiary one, that is lean company. We are going to calculate the NCI of a lean company. For that, subsidiary profit is required, and the profit of a subsidiary of a lean company is 16,000. And let's make all those adjustments which arose in a lean company financial statement or the financial P&L. First of all, let's recall that the fair value depreciation, it was in the Mira's book, so we are not going to adjust that fair value depreciation in the lean's financial statement or lean's profit. Second thing is URP was also in the accounts of Mira company, so we are not going to adjust that one. And third one is the goodwill. The goodwill of the lean company was impaired, so definitely we are going to adjust that one, and 1,000 of the impairment loss would be recognized. And one thing that is identified over here in the adjustment, that company uses the fair value method, it means the impairment loss would have an impact on the NCI. Otherwise, if the company used the proportionate method, definitely we won't be entertaining that impairment loss in the working of NCI. So the impairment loss of 1,000, no any other adjustment is required, right now here. So the adjusted profit of a subsidiary company is 15,000, and the percentage we will be applying on the lean company, that is the acquisition was 80%. That was 80%. Okay, 80% is the percentage. So 15,000, that is 12,000. That is the NCI. That is the NCI. Sorry, we will not be taking 80,000. 80%. We'll be taking what? 20%, as 20% is the NCI. So NCI, the NCI of a lean company is 3,000. Now let's calculate the NCI of another subsidiary, that is the Mira company. So Mira company subsidiary profit for the year is 22,000, but don't forget that's a full year profit and we acquired in the mid of the year. So definitely we are going to prorate in number of months, that is post acquisition profit, and this would arise as 22,000 multiplied by 6 and it is divided by 12, that is 11,000. That is 11,000 is the post acquisition profit. And let's recall what adjustments were required. Number one, the depreciation, fair value depreciation adjustment was required, and the depreciation amount was that was 2,000. Yes, but the thing is, this will be deducted. Okay, another adjustment, that is the URP, as goods are sold by subsidiary to parent. Always remember, if the goods were sold by the parent to subsidiary, definitely we won't be adjusting, we won't be entertaining that URP in the calculation of NCI. So the goods are sold by subsidiary company, subsidiary to parent, therefore we are recognizing, we are eliminating that URP from the subsidiary's profit. Okay, now the URP amount was, that is 1,000. So we are going to eliminate that unrealized profit from the books of subsidiary company, that is the Mira company. And any other adjustment if we would like to account for, no further adjustments are required. So sorry, that is 8,000. 8,000 is the adjusted profit, it's not NCI. We are going to apply the percentage of NCI, and the percentage of NCI in case of a Mira company, that is 25%. That is 25%. So 8,000, 25%, that is 2,000. That is the NCI of a Mira company, and that 3,000 is the NCI of a lean company. And if we are going to add up both the NCIs, 3,000 plus 2,000, and the remaining would be, the balancing figure would be the group profit. Balancing figure would be the group profit. Is it clear? That was the consolidated P&L, of multiple subsidiaries. So the question arises, can examiner test for the consolidated balance sheet of a multiple subsidiary? No, it's not the part of your course. The consolidated P&L of multiple subsidiaries can be tested, but the testing of multiple subsidiaries is the possibility or the probability of testing multiple subsidiaries in FR paper is quite low, but it was not a difficult task, so that we have discussed this in this video. I hope you got each and everything. If you have any queries or if you wanted to discuss anything, definitely you can discuss. You just note down my contact number. You might have my number, so that is 9233 2266 and 721. That is the contact number. You can definitely contact me for any queries and concern. So thank you so much.